Rideshare company Uber says that it will not be cutting its staff, despite major layoffs happening across the tech job sector. The company says that it's in, quote, a good place. Its competitor Lyft recently cut 13% of its staff. Food delivery giant DoorDash also announced that it would cut more than 1,200 jobs as it looks to trim expenses. So for more on this, I want to bring in Jackie Davalos. She is a tech reporter for Bloomberg. So, Jackie, this is really interesting. Uber CEO says that the company's in a good place right now and will be able to avoid additional layoffs. But this is really bucking a trend within the industry. And you could say, OK, maybe Uber's different than other tech companies. But then you have Lyft that's cutting. You have DoorDash that's cutting. What is Uber doing differently?
They're certainly the outlier here, and especially at a time when there's such turmoil in the industry, it really makes you wonder what the underlying driver is for such confidence. And one reason for that is because Uber, unlike Lyft, has a food delivery business that's been able to keep it afloat. When ride-hailing demand completely cratered during the pandemic, it was able to funnel a lot of investment into the sector, which is, it was booming. People were ordering from home, takeout, breakfast, lunch, and dinner. And so as the company has actually become a lot leaner, it doesn't have to deal with a lot of the issues around profitability at its underlying ride-hailing business and food delivery business to the same degree that it had to even 2 years ago. It's gotten a lot more responsible with hiring, which, you look at competitor DoorDash, also in the food delivery business, admitted that it got a little too overconfident with hiring. It got ahead of itself, and now it's having to pay for that through layoffs.
So, part of the reason why we're seeing so many layoffs right now is because it's the end of the fourth quarter and, companies start to look at their books, but also, this possible threat of a recession coming in the next year. What does Uber see in the economy that maybe other tech companies don't?
They're still fairly cautious. Even earlier this year, CEO Dara Khosrowshahi said he would slow hiring a bit, that they would become much more responsible and disciplined, were the words that he used. So not exactly a full-on hiring freeze, but just redirecting headcount where the money was actually showing up. So again, the food delivery business versus, perhaps some other projects that just weren't yielding as much return. You're also looking at, companies like Amazon, Intel, a lot of the tech giants that were largely more insulated from these kind of cyclical moves. I think Uber also takes that into account. It said that a lot of the consumer spend is shifting from retail to sectors like services, which definitely benefits its business because people are still hailing rides and ordering takeout.
So as we sort of go to the 5,000-foot level or whatever the level's supposed to be, what does this say about the tech industry moving forward? I can't really figure out if it's just that a lot of these platforms expanded too rapidly during the pandemic with the expectation that there would be this permanent shift where we all would be staying home and that just didn't pan out. So it's a correction. Or if we're seeing more than a correction, that maybe, these tech services are not what we want anymore.
I think it's two things. One is that, the pandemic completely shifted how people spend money, and that benefited companies like social media platforms that were vying for as many eyeballs as they can to get advertising dollars. They largely put a lot of their eggs in that basket, and now that you're kind of seeing some of those ad dollars pulled back, those business models are having to grapple with that. The retail sector, think of a giant like Amazon, completely benefited from, the surge in delivery. And so I think when you look at the broader movement in tech, it's that investors are going to become much more, they're going to scrutinize the profit, the bottom line, the free cash flow versus growth. And that's something that really hasn't happened in the past in the era of, lower interest rates. So it's a broader movement from the investor expectation side, but also just how consumers are going to kind of revert back to some of the pre-pandemic habits.
Interesting stuff. Jackie, thank you very much.